The afternoon snooze post-lunch. Very comfy chairs here. You're going to have a great time. Hello and welcome back to Intersekt Day 2. My name is Simon Thompson, the editor of startupdaily.net, the host of the Startup Daily Show, 2 p.m. on ausbiz.com.au, except not today because I'm not there. But we are having a fun show there because I did an interview about sophisticated investors and had a panel together. Funnily enough, a guy who was in VC who makes all of these decisions, but of course isn't paid enough to be a sophisticated investor, so he acts like one, just legally isn't allowed to be one. Interesting discussion. Joseph Heller would have enjoyed it, I think. Well, our first panel for the afternoon is going to be about the role of fintech in helping broader business, and we have a pretty epic group of people to talk about it. A couple of great storytellers. I met Dash last night, and we could almost fill an entire panel with Dash's stories. Dom, of course, has a similar talent and was helping us all enthralled. I still think we should stick Dom in the Regent for about an hour and a half, and he could tell a whole bunch of stories about his life building startups and fintechs, and everyone would be enthralled. But we do have Samina Hussain Lech. Sam, great to have you here from Square. We have Dash Liscombe from EML Payments. Dom Pym, of course, from Up and Up and Up and Up. Having a great time doing it. And the fabulous, the Eartha Kitt of New Zealand, the Adrian Muir from VoxSmart. So guys, yell, scream, clap, stamp. Come on, welcome to this panel. That's it.
Can you
Yes.
hear me? Come on in, everyone. Strap in. This is going to be the best one you've had yet, all right? Thank you very much for the introduction. So welcome, everyone, to today's panel. If you want to come up nice and close, we have been told there might be a few T-shirts thrown to the crowd. I'm joking, but we might. So for best question or something, yeah. Maybe a pen. Sorry, it's so Kiwi, isn't it? Okay, so today's panel is, obviously we've got the formidable team in front of us, but just to introduce myself, I'm Adrian Muir and I'm the Group COO at VoxSmart. We're a RegTech fintech. We're headquartered in London, offices in Madrid, New York, and more recently APAC. I've come back from London to live in Queenstown. My first Intersekt and my first panel with these guys, which is amazing. Just quickly, VoxSmart works with some of the world's largest fintechs and banks. We provide communication surveillance and we make sure that we're leveraging the latest AI and machine learning tech. And I've ticked the box for my communications team. Let's move on. I'm not biased, but this is an amazing panel today. We're going to hear from the very best in payments and digital banking, fintech leaders in their field. Today's panel, as you heard, is titled The Role of Fintech in Helping Broader Business. And while it is a broad topic, we worked really hard to make sure that you walk away with something incredible as you leave. I'm guessing it's not lost on you here today that today businesses and their people are really focused and having to be forced to do a lot more with less, right? And actually having a number of conversations with people last night at dinner and yesterday and networking, we're hearing more and more about what is it we can do to really help. And what is it that fintech and everyone here as well, what are you doing and what can we do to help broader business and help reduce complexity in how we live, how we work and how we do business. So we've got some amazing people on this panel that have done exactly that, if I'm really honest. So we've got Square make it easier for businesses to start, adapt and grow. Up make it simpler for consumers to manage their personal finances. And EML make embedded finance easier. So keeping that title in mind, I'd like to make sure that I formally, properly introduce everyone because we've got Dash, who's our product director, as you know. Dom, somebody called you last night the godfather of fintech. I thought that was kind of cute. Let's Google that. And also, last but not least, we've got Sam, who is also Square's payments partnership and industry relations. So let's crack on and have a chat. We've only got 30 minutes and I want to keep it broad. I'm going to throw it to you first, to my left, Dash. In your experience, how have you seen the landscape change in the last sort of 5 to 10 years?
Thank you very much. I think over the last 10 years, I can see 3 significant changes that come to mind. The first is cost. The cost of payments and finance in general has dropped precipitously, but so has margin. And this is something we're keenly aware of. And this is forcing a lot of realignment in our industry, a lot of consideration about where we should be in the value chain, and where additional spaces of value are being created that we can move into. So I think that's one of probably the first one that comes to mind. The other is that finance, payments used to be a heavy point of friction in moving value from one place to another. And increasingly, what we're seeing happen is, of course, that friction has been reduced dramatically, but also that in itself, financial services are becoming a source of value creation for adjacent industries, where rather than simply a friction point in delivering their core value propositions. And then thirdly is that topic we talk about a lot in these conferences, not fully realized yet, which is embedded finance. And I think that's an area where we're going to see a huge evolution in the future. And this is an area where as EML, we like to focus on, and we see our future. So we see that the industry is sort of separating into those that are platform players that are going to try and do high volume, low margin, better and better. And then there are going to be those who focus more on particular problem solving for industries and segments. So at EML, this is the area we like to look at. And for example, there's the salary packaging industry in Australia, where we now have 90% market share. And what we did was, when there was a regulatory change, and it meant that the banks were no longer interested because they want to offer a one-size-fits-all policy, product, we looked at that and we created a regulated product specifically for that industry that answered their needs. And as a result, we captured 90% of the market.
I think the answering the needs of what's required is really interesting, and we've all seen the little square things that we're everywhere in terms of FPOS, and I know that you've done a number of things as well in terms of banking, Dom. From your perspective, I mean, you've done a number of things in the last 5 to 10 years. What have you seen as also, Dom?
Yeah, I mean, it depends on how macro we want to go, but fintech is an industry in and of itself. It's one of the largest industries in Australia, financial services. And, the acquisition of Afterpay is a good example, the biggest in Australian history. So the thing I've seen is capital flows into the Australian market and access to capital being more possible for founders now than it was 10 years ago. The other is the extraordinary talent that we have, not just in this room, but in Australia. And, we've been able to see organisations like Square and others set up their headquarters in Melbourne or Sydney or other cities in Australia because of the extraordinary talent that we have here. And then we've also seen the other side of it, where the different fintechs that I've been involved in over the last 10 years have lost a lot of their key talent to offshore. And so I think Australia is recognised as not only having a booming sector, but now having access to more capital to help grow that sector, and then also having the intellectual capital to be able to actually fulfill those promises to deliver better solutions or to disrupt. And so they're the sort of, I would say, broadly speaking, the main things that I've seen change in the last 10 years. What I'd like to see change in the next 10 years, is that another question? Or can I just slip that in?
I'm going to surprise everyone at the end with that one. He's just ruined it. It's all right, Dom. No, but I think it's a really good point, though, in terms of talent, right? And we've seen, I don't know if anyone realises there was a pandemic recently, and we've seen a lot of people. I've come back from London, and I'm now living back in New Zealand. We're seeing a lot of people come back and bringing a lot of their talent and understanding. Regulatory environments are changing. They're coming back with the incredible technical talent. Are you seeing that, Sam? Is that something that you're seeing as well, and how that is benefiting the kind of wider ecosystem of what's happening with our smaller businesses here within Australia?
Yeah, I mean, specifically on the talent part, I know back in the midst of the pandemic, that was a big challenge, and probably is still a big challenge for a lot of businesses to attract the right talent. But we were actually on that cycle of seeing people return and being able to attract really good talent off the back of that as well. Specifically to the question about what we've seen over the past 5 to 10 years, I wouldn't mind giving my perspective on that. Because I think Square has an interesting story to tell on that as well. And so I think, what we've seen over the past 5 to 10 years in Australia is that fintech has really gone from something that, there were fewer fintechs, and they were often seen as a threat and, challenging the status quo. And that's what fintech does really well. They look at existing problems and they bring a new solution to very long-standing problems, and they solve them in new and innovative ways. And 5 to 10 years ago, a lot of incumbents saw that as a huge threat. And, that's certainly, a well-known story for Square entering the Australian market. The incumbents saw us as a big threat. But what we've now seen over the past 5 to 10 years is that that's now moved from a competitive threat to actually cooperation, and fintechs can actually work with incumbents to provide really great solutions to consumers, like what Up is doing, or to businesses like what Square is doing. So I think that's been a really great shift. And the other thing that we've seen out of that is the benchmark is just consistently moving in Australia of what is extraordinary to what is the norm. And so you think about what Up has done, and when you first launched, it was extraordinary for a consumer to be able to, get a bank account within minutes digitally on their mobile phone. No one was doing that. The same as Square for businesses, to be able to set yourself up to accept payments within minutes, or to walk into a retail store and purchase hardware. That benchmark is now the norm. It's now the status quo. And so fintechs are really helping lift the bar of what is the status quo, and we keep accelerating that in Australia. And we've seen that really shift over the past 5 to 10 years.
And that's an incredibly interesting point, right? Because we're in a situation where you've sort of seen things move, right, over time. So what do you think businesses need now? I mean, looking around, I think I sat on a panel yesterday, and we're talking about the amount of small businesses we've got out there and what we can do and what we're noticing. What do you think they need now? And are they focused in the right direction? And what can we be thinking about perhaps in terms of leveraging our experience? Because you're right, you're not the word fintech and some of the things we're doing around innovation is not as scary anymore. People are much more familiar. Look how many people are around today. What is it, do you think, that these businesses need right now from us?
Yeah, I mean, we talk to our sellers all the time, and we're talking to business owners all the time. And the biggest problem that businesses are facing, whatever type of business they are right now, is staff shortages. And we know that's a huge issue. But business in Australia are extremely resilient. And what we've seen is that they are looking to do more with less, like you said, Adrian, in your intro. And so they're really leaning into technology specifically to help them do more with less. And actually, that's not just businesses, that's individuals as well. That's consumers. They're looking for solutions to help them manage their finances or manage their business and automate things that they just don't want to spend the time doing with pen or paper. So things like managing their inventory, things like, marketing to their customers, they're really leaning into technology to help them do more with less and give them back time as well.
Can I just add to that? I mean, I agree, but I would also say that maybe 10 years ago, we would talk about how every company is a technology company because they have to, install computer systems to automate or to recruit or to whatever it is they're doing, to manufacture. Actually, I think now what's happening is every company is a fintech because the two things that are common across all industries is technology and money. And so we can look at ourselves here as really early adopters, disruptors, the first movers in some of these spaces. But a lot of the things that we're developing in the fintech industry are actually now becoming that commonplace. And I'll just also add that in the Australian market, the big banks are pretty awesome and their technology is awesome. And therefore, on a global scale, the bar for an Aussie fintech is much higher than an American or a British or a Chinese fintech. And that's just a fact. So that means that not only are we seeing every company becoming a fintech, but everyone in this room is now having to do more in order to compete or disrupt. And I think that's definitely one way that we're impacting all businesses.
Yeah, I'm not quite as rosy about the position in Australia. I've come from Europe and the Middle East, and also had quite a lot of exposure to the Southeast Asian market. And I think one of the things we've been quite slow on is the regulatory environment here. So it's regulation that's driven a lot of this innovation. And I think by and large, regulators globally have been very aggressive in the financial services regulation space to drive innovation and open up the economies there, create competition. We've been a bit slower here in Australia. So I think when you compare it with Europe, and particularly when you look at things like the data economy that's going to be so influential, we are a bit behind. And I think what businesses need is for the regulators here and then the fintechs building on top of that regulation to create the platforms and give them time to create these new use cases that they will need before there's too much global competition coming in. So from an Australian business point of view, I think we need to give them the platforms to innovate and create these new use cases of the future on their products and services before probably the second trend, which is going to be the increasing globalization of the ecosystem.
Do either of you want to comment on that?
I agree. I will just say, though, that the flip side, and you probably hear from the regulators, the flip side is that Australia has been able to weather the financial storm and the challenges that we've faced over the last 10 years, perhaps better than Europe and perhaps better than the US and some of the Asian economies. I'm just putting it forward as a
different regulation.
Yeah, obviously, yeah. But I'm just saying that there is this nanny state that we live in, which is highly regulated, and it has a positive and a negative perspective. And I just think they're both valid, right? Absolutely, we're in a challenging regulatory environment. I think that challenging regulatory environment requires additional innovation. So just as an example, when we wanted to start a bank in Australia, it was very difficult, and I've told the story many times, but you need hundreds of millions, and you need a banking license and all that sort of stuff. Because the regulation didn't support it, we had to invent an entirely new way of doing it. And we did a contractual, joint venture, a legal arrangement. We talked to the regulators, and we got that through before the regulation changed. And we didn't even have a chance to get a restricted ADI because it didn't exist. So I think in that sort of tighter regulatory environment, yes, there's global competition, but it also demands more of people in this room to be a little bit more innovative in order to disrupt.
And I think the story of the story of kind of working closely with regulators and helping educate them is not a new one, right? We need to be working a lot more closely. But you guys have all been around for a little bit longer than perhaps some people. I think it's really important too, looking around, we've got some people who've been in this sort of environment for, I don't know, a year or 18 months, right? And they're sort of looking at you guys thinking, yeah, well, of course, you've done X, Y, Z.
Yeah, we're old.
Well, they are thinking that, but you said it. So what I'm really interested in too is, some of the kind of the stepping stones that they could possibly be thinking about when it comes to what they actually need. I love what we're doing here with Intersekt. I love what the Australian Fintech are doing as well to help support. But is there anything else that you can think of as you sort of have looked overseas, Dash, or you've looked at other areas around government, treasury? Is there anything else you think might be of interest? It's an off-the-market question.
She didn't prepare us for that one. I don't mind sharing a thought on that, though. Look, just kind of back off the back of that conversation around regulation, I do think that we have this incredible environment in Australia where you can push the boundaries and kind of solve problems and do it. We have an environment that enables that. Sometimes there are things that we have to wait for regulation to, like in the crypto space, for example, I think regulation is really going to help enable boosting that forward. And that's where regulation can really help. But there are parts of our industry that are so over-regulated that it actually makes it really hard to innovate. Like the card issuing industry, for example, that just seems like a space that actually competition is difficult, and for new entrants is difficult as well. So I don't know if that answers your question about what else we can do, but I think it's staying focused on what are the problems that we're trying to solve, and not to feel like we have to work within the existing boundaries to deliver that. And I think Square's a really good example of that, of doing that.
Yeah, I just want to add that I think that, we've talked already about technology, finance, and regulation. Those three things are important. We talked a little bit about capital. All of those things are important, but there's many ingredients to make a startup or to create a fintech. And we have a bit of a saying that we talk about. So obviously I work it up, but outside of that, I work with a lot of people in the room. And we have a saying about building an operating system for startups in Australia. And the reason we sort of coined that phrase is that it's actually a lot easier to set up a company in Europe or sometimes in some parts of Asia, and certainly in the US. Stripe Atlas means that I can just, as a startup founder, instantly set up a Delaware company, take payments, have a website, do all these things that you want to be able to do. I've got access to Square and all these amazing things that I can do in that market. That's not the same in Australia as it is internationally. So I'm kind of arguing with myself, but I am saying that it's not just in relation to one thing like money or talent or regulation or whatever it is. It's actually about enabling for everyone here to be able to not only lift the bar and beat the bar, but then continue to lift the bar. And that's why I think that the environment is quite friendly. The regulators are all here. Yeah, we're walking around meeting the RBA, meeting with APRA. They're all here. That's unusual, actually having them in the room and being able to talk directly with them. The venture capitalists are here. So I just think that there's an opportunity for all of us to work together to continue to raise the bar beyond where it is now.
Speaking for EML, we love the regulators.
I think they got the memo.
Just want to get that out there. But we would love to see something also along the lines of the money regime out here as well. But as an issuer and processor, we're quite happy with the regulations there.
Well, there are other things like CDR and open banking and so on, where Australia has been very late to the game, and even the changes to the banking licenses. We were 3 or 4 years after Europe. So there's definitely a lag in Australia. We're a long way away from the rest of the world, and there's definitely areas where we can do better. I think the CDR, for example, is a better implementation of data personal privacy than any other in the world, including in Europe. But we're miles behind where Europe is, and it's a long journey to get everyone to adopt those standards.
I absolutely agree. I think that's going to be critical for us because that's going to be a completely new type of economy. I mean, NPB is great, but it doesn't really change the use cases very much from a consumer point of view. CDR is going to be completely transformative. And I worry a bit from the Australian business point of view. And I'm not talking about the fintechs, but the businesses that rely on the fintechs in this space to adjust their propositions to compete in the information age. That the overseas competitors will come in, and a bit like Square in a way, right? Because Square took a long time to prove itself, to make all those learnings. But once it did, and it hit its straps, suddenly it exploded everywhere. And I worry a bit that the overseas competition will have had a lot longer in this information economy, and then they'll come in here and the local businesses won't have been prepared.
I mean, I've obviously been living overseas since about 1998 when I was 3, but I think you need to understand. I think you're over egging it a little bit. We come over here, and there's some incredibly amazing talent companies. I've spoken to a number of people here, and I think you're underestimating just how incredible some of the areas are we're dealing in the talent. So I just want to make sure
Wouldn't be a good panel if we all agreed with each other.
Well, I'm not saying you have to agree, but I'm really interested that everyone in this room also gets some sort of idea about a little bit of wisdom from us, right? And again, we have been around for a while, and I think in terms of time, I want to throw some questions out to the audience as well, because you have got an incredibly smart panel up here to ask questions. But my final one is just, you've trodden the path, right? Knowing what you know now, and the conversations that you're having, and the sitting on boards, etc. at the moment, and what are the things that you think will be the biggest issues for us in the future, and what are some of the key things that the future might hold for businesses in terms of fintech? I'm going to ask you probably, Dom, first, because it sounds like this is something that you would love, because I think it's important to be leveraging experience in the situation, because it's a lot of people that I spoke to last night that are still like, I'm thinking about going to the UK, I'm thinking about maybe going to the US. I'm not quite sure about what I could do here, or how do I get the right talent? There's lots of questions, but what do you think are going to be the big things we're thinking about?
Yeah, so I'll just start by saying I'm working with Marnie, who's the managing director of the bank, and others on a 25-year strategy for the banking group. And that's very, very difficult. Like, we don't have a crystal ball. But what it's taught me by going out and talking to people and trying to put together a long-term strategy like that, and other people might have heard me talk about UP's 100-year strategy. That sort of forward thinking, it helps you set a big, hairy, audacious goal, even if you'll never achieve that goal. It's like Elon Musk saying we're going to colonize Mars, but we're building cars and putting up some satellites and things, right? So I think that when we talk about the future, we can look 1 year, 10 years, 100 years into the future. The things that we've talked about, all the topics that we've talked about, I think they're the critical topics, particularly talent. So the pandemic, as Sam mentioned, has made us sort of reflect on the fact that people are moving back to Australia. As people are moving back to Australia, there's opportunities to work with them face to face, but we're also much more remote. Everybody's working remotely now. So the world is actually our talent pool. What I like to talk about is the innovation and the creativity, disruption and inventions that have come out of Australia. I won't bore everybody with it right now, but carbon fibre or Wi-Fi or these sort of things, they're incredible. Google Maps, they're incredible inventions that have come out of our minds. And they've taken over the world everywhere you look. So for me, the future should be able to support more of that type of innovation. And I like to think about it as intellectual property and intellectual capital. So intellectual capital is the people, intellectual property are these ideas, these assets that we create. Now, whether they're software or whether they're physical assets or whatever it is, we need to build an infrastructure and environment that can support that over the next 10 years so that we can continue to have investment from the regulators, from the governments, from the state bodies, from the industry bodies, and from all the minds around Australia in order to create the products of the future and then export them to the world. It was a bit esoteric, but
Loved it.
sets a vibe.
Well, that's broadening it even more, I think, the whole of economy. But I agree. I do notice here, I think sometimes the mindset in Australia needs to change a bit. It's quite insular now, as you say, even in terms of talent recruitment. So very few companies, for example, employ people outside Australia directly, but it is possible to do that now with current platforms. I think there's going to be, but the thing I think will completely transform us is both, as I said, the information economy, but also the opening up of the regulatory space to be transnational as well. And I think those are two things we will need to be prepared for in the future.
And Sam, I know that we touched on this when we were having a chat before. What are your thoughts?
Yeah, I might just give a slightly different perspective just to add another flavour to this question around, what do we see over the next 5 to 10 years? And we started with what we saw over the last 5 to 10 years. And I think from Square's experience as well is that, we are going through a challenging economic environment at the moment for everybody. But we know that the nature of markets are cyclical. They go up and they go down. There's a lot of noise when it happens. And I think what's really important for organizations and all the fintechs here and the founders of fintechs, whether you're working for a fintech, whether you're 10 days old or 10 years old, is staying really, really focused on your core purpose. And that will enable you to go through these cycles. Square itself was born in 2009 after the global financial crisis. And, these environments, these bear markets are an incredible opportunity for fintechs in Australia and globally. We're here to solve problems and we do it in really unique ways. And so I think it's about staying really focused on your core purpose. And at Square and across Block, it's about empowering more people to participate in the economy. I'm sure you guys have your purpose and you know what it is, and it's about staying really focused on that so that you're not distracted by the noise, you're not too distracted by the immediate challenges, and that you're really focused on meeting your customers' needs and surviving the next 5 to 10 years and thriving as well.
I totally agree. And I think there are those immediate challenges that everyone in this room is more than likely facing. And we have got the role of fintech in helping the broader business and the conversations that we're having. I think when I started my role back in 98 years ago, right, fintech wasn't even a word. Okay, so I've been in fintech forever, but it wasn't called that. And over time, things have evolved and changed. And I think that's a really important piece for us to remember. And I've spoken to a number of people at the moment just talking about how hard it is. And I've been in capital markets for years, and then in my role, I just know that it's probably the hardest one I've had. So I want to make sure that you've got a group of people here also that are hoping to be very helpful in answering some questions. Am I allowed to throw it out to the audience? Because it's Dash, Dom and Sam's show. So please ask them some questions because they have been very forthcoming with their...
Well, I could ask myself questions.
Go on, ask. I've got a question if we know.
Oh, this is your Kevin Rudd impersonation, Dom. Come on, we must have a couple.
You get a T-shirt.
Oh, here we go. Christian's a man who really needs a T-shirt.
I was lying about the T-shirt.
So, we're off.
Thank you. I think the topic of this discussion, this panel, has been a really important one for the overall Intersekt, sort of the depth of Intersekt here, because very often it's easy for us working very closely with regulators, with banking partners and others. We never really move outside of fintech. So it's sort of who are the enablers and the other stakeholders inside fintech. So looking across your businesses, and anyone can jump in on this one, where do you see yourself supporting, as we talk about here, the broader business? Is it a lot of the conversation has been around raising the bar? And I don't know if you mean that in a broader sense, look, fintech can do it, therefore you can, but it's not actually proactively working with them. In what ways do you see yourself or fintech overall supporting a broader, broader societal development?
Maybe I can add to the question as part of the answer. To me, there's two different ways that fintechs can impact broader business. One is by servicing those broader businesses, by providing a product or a service in order to help those other businesses, other industries. And the other is by leading by example. So the example that Sam gave, where Up became the first instant issuance of a card into a wallet, that might sound like a small innovation, but that's teaching other people in other industries that they can compete with the incumbents, that they can set the bar higher, that they can do things. So we can actually be a leading force as an example for other industries. That might be education, or might be mining, or aerospace, or whatever it is. So I think they're the two ways that we can impact, and I think that each of these businesses impacts other industries partly in both of those ways. And so Up doesn't service other businesses, but what Ferocia, the business behind Up, has done is helped at least 5 banks in Australia to improve their digital capability directly, and then potentially tens or hundreds of banks in order to lift the bar. So that's directly and indirectly assisting those others within our industry. Outside of our industry, we meet with all sorts of people who are inspired by what we've been able to do and how we've been able to do it. And I think that is important. I think everyone in here is an inspiration for people in other industries that are maybe struggling to have that same sort of disruption.
Couldn't agree more. We've got time for one more question. I know there's one more. Does anyone want to?
Or maybe not, Adrienne.
Go on then. Yeah. We done? Yeah. Okay. Well, listen, I think we're done. Are we on time?
We're a little bit over, sorry.
Oh, I'm so sorry. We're a little bit over. Damn. Hey, listen, I'd like us to all put our hands together and say thanks to the incredible panel. We've got Dash, Dom, and Sam. Thank you very much for attending. Grab them afterwards. Have a chat. Thank you very much.
And thank you to Adrienne as well. Dom, great to hear you have a 25-year banking plan and a 100-year one. I've done the same thing. I call them my mortgage repayments, which are now, after the RBA decisions, are running on a 100-year time frame. Of course, the other great Australian innovation he didn't mention was the Hills Hoist, along with the wine cask. And when you put those two things together, magic really happens here in Australia. Thank you for that fantastic panel. Well, now we are going to both drill down and take a sky-high view of what is going on. Is the global economic environment helping or hindering Australian fintech sector growth? And to do that, Cheryl Murphy, the EY Oceania Chief Economist, will join us for her presentation. Cheryl helps clients to understand and interpret the economic background. She uses her commercial acumen, public sector experience, and analytic skills to see through the noise, giving clients timely insights and to identify risks and opportunities that are changing phases of the business cycle. Cheryl publishes regularly and is a trusted advisor in economic and policy issues for both domestic and international clients and stakeholders. Prior to EY, she was the chief economist at Austrade, helping guide the Australian government policy in trade, foreign investment and tourism. She also spent 15 years at ANZ Bank, having started her career as an economic research analyst with the RBA. She also worked as a journalist at the AFR, which is when I first met her. She is a brilliant woman. Please put your hand together and welcome Cheryl Murphy.
Hello, good afternoon. Lovely to be here today. My job today, I guess, is to stand back a little bit and look at the global environment and particularly how it might affect the fintech sector. I'm not going to get into regulation because I don't know enough about it, but I am going to talk about the bigger picture issues that might be affecting the industry. So when I think about this, I can't help but go really big and start with the global economic trade environment, because there's been some problems recently. This is just, I guess, an indexation of both global trade and global GDP. And you can see that as of the global financial crisis around about 2008, that the two lines really started to diverge, with global trade in the pink falling right behind global GDP. So this is problematic because it means that we are, I guess, trading less relative to economic activity around the world. And that means that we're not getting the gains from trade, if you like, that we otherwise had been enjoying up to that point. Now, there's a number of consequences of that. Trade is beneficial for all of us. It lifts our standard of living, and it does make us all better off. It also is quite deflationary because a lot of the trade that takes place across the world is, of course, putting downward pressure on prices. And as you know, at the moment, with inflation a problem as it is, that can be problematic. So it's not something that we like to see happen. And I think probably what's the most concerning here is when you look at the last little bit of that chart, you can see that global GDP has taken off again and trade's gone the other way. And that's obviously to some extent related to COVID and the fact that supply chains started to break down in that period. But the other thing I'd also point to here is geopolitics. And as you know, there's a lot of tension around the world at the moment, and some particularly acute. These indexes are just taken from a group called Policy Uncertainty, and what they do is scrape news websites to get a sense of the types of terms that would indicate that there is geopolitical uncertainty in the world. Now, they're not perfect, but they are, I guess, a bit of an indicator of what's going on. And you can see that in the blue line in particular, obviously a spike at the beginning of the war in Ukraine, with that one picking up quite a lot. And then that pink line, the World Uncertainty Index, also kind of sloping up a little bit, again, starting around about the time of the global financial crisis. I'd suggest that that is too a reason why global trade and GDP are not moving quite so in sync anymore, with people getting quite protectionist and worried about the consequences of linking their supply chains into other parts of the world. And of course, on the horizon, well, hopefully not on the horizon, but certainly bubbling away, is the tensions between the US and China and the Taiwan situation. If anything, of course, that would suggest that we may even see further geopolitical unrest in the future. And again, it's something I think that we should all be thinking about, because there won't be a business in the world that's not affected by that if some tensions became more obvious and conflict broke out. There are, of course, humanitarian problems resulting from the extreme events that we're seeing in the war in Ukraine, and not for a second underplaying those. But if we were to focus on the economic consequences for the moment, they're being quite severe, as you know. Immediately, of course, what it did was increase energy prices. It increased global food prices as well, with a lot of global gas supply, oil, and wheat, barley, fertilizers coming out of the Ukraine or Russia. But I guess the most immediate problem is this incredible pickup in electricity prices in Europe, which is, of course, a result of some of the energy supply problems that we've seen. This is really alarming. I was at a presentation yesterday by Glenn Stevens, the former governor of the Reserve Bank, who said that this is definitely worse than the oil price crisis that we saw in the mid-1970s in terms of its impact on inflation. So this chart is just showing you what electricity prices have done through Europe and what futures are telling us. And at the moment, wholesale electricity prices are about 20 times what they were in Europe between the years of 2012 and 2020. 20 times, amazing. And then, of course, futures prices are suggesting that they'll actually go up substantially more. Now, again, this affects all of us, because this effectively will, if these prices come throw Europe into recession. And it's something that it will touch a lot of the world. So it's a really unfortunate and very difficult environment. Policymakers in Europe, of course, now looking at stepping in and capping prices to actually make that market run more effectively. So the bottom line, I guess, for the global economy is that we are looking at something that's a lot softer in the coming financial year, and probably the year after, than we've just seen in the previous financial year. Just taken a selection of the major areas around the world. Obviously, we can see quite clearly there the COVID dips, so the contraction in economies related specifically to the shutting down from COVID. And then we see this kind of big bounce back from a lower level. That was last financial year. The current financial year looks much slower, and it really doesn't matter what part of the world you look at. It's a fairly universal story. Perhaps China's the only one that didn't fall into recession, but of course a slowdown in China, even if it doesn't fall into recession, does again affect the whole world, given it's a trading partner or the largest trading partner for many countries. So it's going to be a harder 12 months, is what I'm saying, from a global economic point of view than it has been. And at the same time, and part of the reason I guess that is slower is because the global economy is dealing with this terrible inflation, which has arisen only over the last really 6 months. I've just taken the headline inflation numbers here from a number of economies, but I could have picked almost any economies in the world, and the picture is quite similar. We've had, from what was exceptionally low inflation in 2020 and 2021, something which has really risen up to multi-level highs, in some cases multi-decade highs actually, through the world. So obviously, a lot of things that are driving up inflation are in common. So again, global oil prices, food prices. There's not many of us that can avoid those two commodities. But there's also been an explosion of stimulus into the global economy from both fiscal authorities, so governments, and of course central banks, who during COVID put in place, I guess, more insurance than they might need to ensure that their economies were stable through the crisis. So it didn't really, all that sort of extra stimulus didn't have anywhere else to go. So what happened is, of course, it caused a price explosion, and that's what we're living through at the moment. Now, the central banks are now quickly trying to reverse that. And that's, of course, why we've seen them lifting interest rates quite sharply. It is not abnormal now to see 50 basis point rate hikes, as we well know, given having seen one on Tuesday. And I'm sorry about your mortgage, Simon. But, they certainly are reining things in really, really quickly. In Canada, they put in place a 1 percentage point increase in one meeting, which, again, we're just not used to that. But as you can see, and the reason I've put it on this big chart of taking it back a long way, is that the movements are from an incredibly low base. And again, you know that during COVID, as I was saying before, the central banks are really trying to stimulate their economies and get things moving. So in other words, they're trying to get back to something closer to normal, something that doesn't overstimulate their economies. So this sounds like a pretty dreary scenario, and I do apologise for that. And you might think, well, why is that the case when yesterday we saw the national accounts in Australia and a 3.6% GDP growth in real terms, which is really pretty strong. And the truth is, it was strong, and Australia has performed exceptionally well last financial year. I think the question is, what does it look like next year? And I think that's where the challenges come in. So yes, we had a great economy. We had exports booming. The consumer was strong. Lots of stimulus in the economy, as we know, from the fiscal money, from the monetary policy stimulus with low interest rates. It all resulted in a really, really good set of numbers. But of course, that's nearly, 2.5 months ago, and a lot has changed since then. One of the problems with an economy running hot as it did last financial year is that it kind of hits its speed limit. And this is just a measure of capacity utilization. It's taken from the NAB business survey. And you can see that it's well and truly kind of at its most recent highs. And I actually think it might be a record high. So if we took the data back further. So what firms are saying is that basically they're using, if this is their kind of total capacity, they're getting closer and closer to the point where they can't produce anymore because they hit supply side constraints. And those supply side constraints may be capital equipment, they may be inputs, and of course they may be people. And so while having a strong economy is very good in a number of ways, and there's lots of demand in the economy, when your supply can't keep up, of course you get into all sorts of problems, including inflation. And one of the reasons, I guess, that at least in the last financial year, that we were doing so well is because of this terms of trade concept, the fact that our international pricing power was so good, essentially all that means is that our export prices was high. So as you know, coal prices were skyrocketing through the last financial year. Iron ore was doing pretty well, even though it's off its highs. LNG prices really strong. A lot of the agricultural production, of course, in the economy as well, has been enjoying really high prices there. I just wanted to contrast for you, and the point of this slide is to say that we are quite different from many other countries, many other developed countries, because we are a commodity exporter. So our terms of trade have been moving up, while as other economies like Japan and Germany, which are, of course, importers of these big commodities and the types of things that we sell, they've been going the other way. So Japan, Germany, its terms of trade falling. Even New Zealand, which again has enjoyed fairly good price rises for many of its agricultural production, has had a fairly flat terms of trade, certainly relative to ours. So Glenn Stevens twice I've quoted Glenn Stevens, but he once described the terms of trade as sort of a measure of how many television sets you could buy with a shipload of iron ore. So in other words, it's kind of like what you import versus what you export. So the fact that our terms of trade is high is really, really important, and it doesn't get nearly enough coverage, I don't think, in the media. This is why. So on the left-hand side, Australian exports, that's just the dollar value that we have been bringing in from our exports of various bulk commodities. The pink line there, which is coal, is probably the most extraordinary one, as you can see. But equally, when we look at the iron ore numbers in the green, also incredible. Remember that back in 2008, 9, 10, 11, we thought we were going through a commodity price boom? It's nothing on this. And of course, the other thing that's been happening since 2009 is that our exporters have been building up their capacity to export. So they've been obviously investing very, very heavily and increasing the ability to get stuff out the ground and ship it off. So in other words, they are raking it in right now, if I can put it subtly. We've seen now profits, and yesterday's data proved this, profits in the resources sector are now more than profits across the entire rest of the economy. So that one sector, which doesn't employ many people, keep in mind, is now making more money than the entire rest of the economy in Australia. So that's important, again, for a number of reasons. Obviously, there's a big skew here on where all the money's at, but it also is important for feeding money back into the system. So obviously there's dividends, there's employee wages, although they haven't actually gone up by very much. But the thing that is going up quite strongly is government tax revenue, because these big resource companies obviously now have a lot of tax obligations. I quite like this chart on the right. It just shows in the pink, quite simply, during the COVID years, there was obviously a dip in the government's tax take, but look how quickly it's come back. This is monthly data from the Department of Finance, and all that's all essentially money from the resources companies. So resource companies paying a lot of tax, which sounds great for the government, sounds great for the mining companies, but it's actually good for all of us, because what that then does is give the government a bit more freedom to A, pay off a bit of debt, B, recycle that money back through the economy. And that's kind of what we've seen. And again, I think this is a fact that's not particularly widely understood, but the Australian government sector at the moment now is spending about, in fact, more than $1 in every $4 in the Australian economy. So they're at 27% of GDP. That's state, federal, and local government. And as you can see, particularly from the green line, which is government consumption, so things like spending on the NDIS, on hospitals, on even the flood relief would fit into that category. That is now sitting very high as a proportion of GDP compared to recent standards. So that is not a dollar figure, that is a proportion of GDP. In other words, I've kind of adjusted for what's going on in the rest of the economy. So lots of money going into being spent by the government sector, taking it back a step because there's so much money coming in from the resources companies. There is also, of course, a lot of debt in here too. The pink line, the underlying public investment, things like roads, bridges, all the big major transport projects that we're seeing in Sydney and Melbourne in particular at the moment, is also quite high. So quite a lot of activity going on there too. So in other words, the government has cash and it is spending it, and it is quite an important influence on the economy right now. And when you think back to what I was saying before about the lack of resources in the economy because we're hitting our speed limits, it actually can be problematic. In other words, it does that crowding out, the so-called crowding out, where the government kind of is using up a lot of the economy's resources, and perhaps at the moment, arguably, it shouldn't be doing that. The labour market, of course, something that's of interest to all of us. I'm sure there's no one in this room that hasn't tried to find some staff and not been particularly successful. I've just sort of taken a number of job survey indicators from around the world and compared it to the number of unemployed people in those individual countries. Australia down the bottom left here, as you can see, very low. In other words, what it's suggesting is that there is less than one unemployed person per job vacancy at the moment in Australia. Now, I kind of thought, oh, well, this is kind of an Australian thing. We're doing better than most. But when we looked at the data from around the world, you could see that this was actually very common. So, in other words, the whole world is in the same dilemma. And it's quite easy to explain. Again, the world was overstimulated by monetary authorities and by fiscal authorities during COVID. There was an explosion in demand when lockdowns finished, and there was more demand than supply. All the unemployed workers got used up. People started moving around jobs, the Great Resignation, people getting paid more, etc. And the result is we now have extremely tight labour markets. And those tight labour markets, of course, means that companies have skill shortages. So in other words, we can't just kind of necessarily pull from a group of employees overseas or a group of talent overseas to fix our problems, because everyone else is trying to do the same thing to some extent. Having said that, the migration program is starting to pick up again, and we saw from the Jobs and Skills Summit last week that the Treasurer does intend to lift our migration program by 35,000 people, which is very welcome. It takes it to 195,000, and certainly it's not the kind of numbers that they probably won't achieve, although it could be a little challenging. But really, again, we're so far behind with our migration. We've had this enormous dip through COVID. We are a country that, of course, is used to having strong growth in migrants anyway, and so when you take that away, I guess we feel it more than most. The pickup has started. There has been more people coming back into the country, more students. You can see from the left-hand side that most of whom we lost actually were temporary visa holders. So it does tend to be students and the low-skilled. And that's, I guess, why the accommodation, food services industries have been, I guess, shouting quite loudly about this. So we will see a little bit of improvement there, but I think it's a while, as you can see from these charts, before we get back to something normal, particularly when the rest of the world is also crying out for skilled labour. I sort of wanted to see if there was a skew in the job vacancies and the demand across industries, but it is actually quite broad. So in other words, almost all industries have been crying out for more people. I've just circled professional services. Their technical services also fit into that category. And they're certainly not top of the list like accommodation and food services, as I was suggesting, with the lower skilled and the students helping fill those jobs, but you can see that there is still a lot of vacancies there, and a lot of demand for labour in the professional services. So you probably want some good news. I don't have much, but I do have this one, which is that the global supply chains do actually look to be loosening up a bit now. We are starting to see some response to the extreme demand that we had for the movement of goods around the world. Of course, there's that movement of goods being accelerated by the fact that we weren't consuming services and we all wanted to, import outdoor furniture and the like from China. So we have started to see some of those come back as capacities come online and our consumption patterns return to something a bit more normal. In other words, if we buy more services relative to goods. The Global Supply Chain Pressure Index on the right-hand side, that's just from the Fed Reserve, just kind of puts together a number of indicators. And then the Baltic Dry Index on the left is a shipping price indicator, which again just shows that even though we had a threefold increase in the cost of shipping our bulk commodities during 2020-21, that has now largely collapsed again. So these are certainly points of good news. So as I was saying, I think that we've had a really good 2020-21. I think that 2022-23 is definitely going to be harder, in part because we have central banks trying to pull in the extra demand to remove the inflation problem, or at least lessen the inflation problem. I think they've got a long way to go on that. We have the challenge of the fiscal money being kind of extracted as well. Governments have taken on a lot of debt around the world through the most recent period of trying to save their economies from COVID, and they're not going to be wanting to increase that pile of debt. So I think any fiscal money that we've been used to, of course, starts to slowly get extracted. These are demand side reasons why the economy won't grow as strongly. And importantly, of course, China's zero COVID policy will impact here too. So when that economy shuts down, or large parts of it shut down, of course, again, we see disruptions to supply chains, demand falling, and less movement of people around the world. So another reason that the demand side of the economy might look a bit softer in the coming year to 2 years ahead. And really, who knows beyond that. This is something that I don't normally talk about because I've never had to talk about it in my entire career. But on the supply side, we now also have problems. As we know, as I've been talking about, geopolitical risk, sanctions, war, all of these things, again, they clog up supply, and they're terrible for so many reasons, but economically, they cause big problems with supply, particularly when you knock out an economy which is a big supplier to the world and something as essential as energy. Again, I don't necessarily see the tensions there getting any better, so it becomes a problem for supply. Weaponization. If there's one thing that countries around the world right now are spending money on, it's various weapons, it's tanks, it's hardware. No, we might not want them to be spending money on that, but they are, and they're consuming resources, which takes it away from others. Part of the reason the Australian government spending is so high at the moment is defence. They don't talk about it, but it's taking up a lot of resources. Population aging. Now, we've known about this one for a while. Of course, the fact that our population is aging and we have workforces which are effectively shrinking relative to those that we have to support, either at the child end and the grandparent end. This is quite difficult to counter. It's hard to invent people, of course. It takes some time. So we will have that. The labour market shortages that we're experiencing now are probably not going to get a lot better. And the last one is, which is a whole topic in itself, and I'm sorry to just mention it briefly, but productivity growth. This is actually where we get a difference. This is how we can actually overcome some of these other problems. So you might not have as many people, so what do? You do better with what you do have. And that's productivity growth at its very core. So we need to see stronger productivity growth. It's been very sluggish for a long time. That's, of course, what the Jobs and Skills Summit was really about last week, was trying to get solutions to some of the problems that we have. And there's some, fantastic ideas out there from people much cleverer than me, and I'm going to leave that one for another day. But productivity growth, really, really important. So what does it mean for the fintech sector? Well, I'm going to stick to the big picture stuff, as I said. If the fintech sector would like low inflation, low and predictable interest rates, well-functioning supply chains, talented employees, and healthy consumers, unfortunately, I think it's going to get a lot more challenging. So, in other words, of course, low inflation, we know we are seeing some elements of the supply chains ease up, and that's taking off some pressure from global prices, and some commodity prices are falling. Oil prices have fallen a little bit, as we know, so a little bit better there, but there's still a lot of domestic sources of inflation and still many problems related, in particular, as I was saying, back to the gas problems in Europe as well. Interest rates, as we know, are going up quite rapidly, and I don't think we're done yet. In other words, I think we've probably got at least another few months of rate hikes from the Reserve Bank and central banks around the world doing similar. Supply chains, as I said at the end there, we are actually seeing a little bit of easing up here as things normalize. And I suspect that that will continue, but it's not quite where it was, and it could take a little while to get back to that point. The world wants skilled employees. We know this. We know that that many corporations around the world are struggling with trying to find people, and I don't necessarily think that we have an incredibly good head start on a lot of other countries in attracting them. So this is going to be a real battle for people, I think, in the next few years as well. And then on the consumer front, actually things have been reasonably good. So we do have challenges for the consumer: falling real wages, really important, higher cost of living, and higher interest rates. But importantly, the strength of the labour markets, the fact that we do have a lot of demand for labour and workforce participation rates are at record highs. In other words, there's more people now taking home a pay packet than ever before in Australia. That gives them a lot of purchasing power. And the fact that people have been saving, they've been really conservative through COVID, and now are in a fairly good financial position, means that I think consumption will hold up a little bit. So I will leave it there. I'm sorry I didn't have more good news, but wanted to end on a high point there.
Sherelle, do you have a second to answer any questions if our
course.
audience does? Yes, I knew there'd be some questions out of this one. And I do want to ask you as I go up, the role of tech in productivity. It has been a big issue, a debate for a long time now.
Yeah.
How much can tech help in that productivity gain in your view?
Yeah, a lot. It's an incredibly important part of the equation. It's interesting, though, Simon, that the research shows us that it's not just technological development, but of course it's how it's used. So when you've got, say, Apple kind of dominating over here, and that knowledge and I guess IP not being shared or diffused through an economy, then you actually don't get nearly as many benefits as if it's actually kind of shared. So it's not just tech, but it's actually the way that it's managed, which obviously governments can do quite a lot about.
Thanks for the presentation. That was awesome. How have economists tried to balance, as you described at the end, that conservative money-saving attitude or behaviour of the economy of people now post the pandemic going, actually, I really want a holiday overseas. I really want to spend some of that money and enjoy my life, which is obviously affecting inflation, yet we're having hikes in mortgages when people just want to kind of have 6 months of living. It doesn't seem like that's been countered.
Yeah, it's really tricky, isn't it? It's I do think there is pent up demand, and we saw, as I say, we saw that yesterday. We could actually, I'm not just this is not just a kind of a suggestion. We actually saw the consumption of or consumption at cafes, restaurants, and takeaway food like bounce back very strongly. Transport consumption went up a lot, which essentially means airfares. So it is actually happening. Interestingly, if everyone took the money and went on an overseas holiday, it wouldn't create any inflation in Australia, but we don't really want them to take the money offshore necessarily altogether either. Look, the Reserve Bank is trying to do its part by, it probably doesn't feel like it's tapping on the brakes. It probably feels like it's slamming on the brakes at the moment. But we do have to remember that the cash rate is still only 2.35% at the moment. In other words, it's actually still quite low by historical standards. So they're just trying to slow things down a bit. I did the project during the week, and I basically said, it's like a responsible parent taking away the beers at an 18th party at around about 11 p.m. So just before things get too hectic and the police get called, the Reserve Bank steps in, cools it down before the party gets shut down. That's my kind of analogy at the moment. So they're trying to slow things down without wrecking it, I guess. So we can still enjoy a holiday, but you can't enjoy a holiday and a bathroom renovation.
Any other questions? All good? Sherelle, thank you so much for that fantastic presentation. I just think it does set a little bit of the stage for the year ahead. Of course, there's always incredible opportunity in moments like this. Ladies and gentlemen, please thank Sherelle Murphy from EY. I thought one of the other fascinating numbers in one of Sherelle's charts was that education and tourism one. It was a blue line from memory that, of course, was climbing pretty steadily and a pretty strong sector in the Australian economy right up until 2 years ago. So I look forward to seeing that one go up somewhere near the coal and iron ore prices. Right, well, battlefronts, we're going to talk those, and business banking, the new battlefront between the banks and the fintechs. Is it a war? Is it sort of just a little shoving it down at the 50-metre line with the Swannies against the Ds? What's going on? Well, we've got a great panel to talk about that. Bo Bertoli, of course, co-founder of Prosper, Ryan Edwards-Pritchard from Cape, Graham Burt from Patron. Your moderator, do we say mediator for this one as well, is the fabulous Jennifer Harrison from Reputation Edge. Ladies and gentlemen, a big round of applause for our next panel.
Thank you, Simon. And thank you for joining us. We're going to put a customer in the spotlight that I know a lot of people have a lot of interest in, which is the small business customer. And I'm joined by Bo Bertoli, who is co-founder and chief revenue officer at Prosper. Hello, Bo.
G'day, how you doing?
Really quickly, could you give people Prosper's elevator pitch?
Yep, sure. So Prosper is Australia and New Zealand's largest online lender to small businesses. We basically build products that help business owners run, grow, and make payments.
Perfect, thank you. Ryan Edwards-Pritchard is founder and CEO of Cape. G'day, Ryan.
Hello, everyone.
Really quickly, what is Cape's elevator pitch?
We're an expense management platform that issues corporate charge cards designed to help you cut wasteful spending and time on financial administration tasks.
And Graham Burt is head of sales at Patron. Welcome, Graham.
Thank you very much,
What's
Jennifer.
Patron's elevator pitch?
So the elevator pitch for Patron, really what we started out life as an approvals engine for payments. And what we're able to do today is actually provide global payments, corporate cards, and document management across 33 different currencies.
Thank you. Bo, could you please explain more particularly what is the particular problem that Prosper solves for, and how do you use technology to do that?
Yeah, sure. So at Prosper, we're now 10 years old. We turned 10 in July. So we have the customer core problem that we've been working on for the last decade. And we also have the problems of the future as well that we're working on. So the core problem that we've spent the decade solving is really around access to capital. So how do small business owners get that vital cash to run their business, to take advantage of opportunities, to bridge them through quieter times, as we've seen the last few years, or to really double down and grow. What we're finding over the last really couple of years, though, is that the customer problem space is evolving, and that we want to be moving more and more into a holistic solution for business owners. So not just solving the access to capital piece, but what happens next when a business owner receives the funding from Prosper? What are they doing with it? Well, they're spending it. They're making spending choices. And how do we help them doing that with the act of that, but also looking at how they manage cash flow in their business? So there's a lot of different problem spaces that covers, and we're happy to go into them in a bit more detail today. But from a high-level perspective, it's how we be that holistic solution under that territory of grow, run, and pay.
And what about the tech that you're using to do that?
Sure. So most of our technology in the early years was built really around things like data aggregation, credit modeling. How do we create seamless and beautiful customer experiences? And that is really carrying us forward. So again, a huge amount of the product and technology investment in our business is how we make decisions. We are a business that takes risk. To put in perspective, we've lent out just under $3 billion in the last 10 years. And over 700 million in the last 12 months. So they're big numbers, and it's very important that we get the accuracy of that right. And we're also always looking at how new forms of technology can help us accelerate our journey. We're sharing some of the earlier startup journeys a bit earlier, and when we got going sort of 10 years ago, we had to build a lot of the foundational components that we use. Today, we can partner with many other technology platforms to bring elements of that together to create these beautiful experiences.
And what is it about the competitive landscape that has enabled or permitted Prosper to thrive over the last 10 years? Because most people would think that business lending should be the bank's core business, their core bread and butter. Banks lend, that's how they earn the bulk of their revenue. What is it about the competitive landscape that means Prosper has had this amazing journey over the last 10 years?
Yeah, sure. It's I mean, the competitive landscape for small businesses in general, I would classify as just an underserviced market. And it's not just in finance and things in and around lending, payments, etc. It's just a holistic problem. They're an underserved part of the economy. So as we got going, and we're 10 years in, but we can still see these gaps in servicing to small businesses. 100% of small businesses have a banking relationship. They have a bank account. They can access terminals and payments and other products. And yet there are dozens, if not hundreds, of fintechs now emerging, some a bit older like us and some in their first early days. So these problem spaces are really big. Just to put the numbers in perspective, just in Australia, there are over 2 million small businesses. That's 97% of all businesses, by the way. And at Prosper, for example, we've got just over 16,000 active customers. So we're not even 1% of the way into this market from our perspective. And a lot of the market sectors that we're talking about are very, very large, with tens, if not hundreds of thousands of underserved customers.
So, what is it that you can do that the banks can't do?
I mean, I'd put it down to three things. The banks, I think, are phenomenal at a number of capabilities, and there's really a couple of things that we can do. So the first is focus. At Prosper, for example, and many fintechs out there, you start on one customer problem and you spend a lot of time focusing on that customer problem. And it means we can really double down and try to create great solutions for that problem. That's very hard when you're running a very large enterprise trying to service hundreds of different problems potentially. The second is from a really customer experience perspective. I think that we're able to look at the customer experience problem in that focused lens and dedicate a lot more time and effort to understanding the customer, and we can stick with that problem until we get the right solutions. And the solution we build today is not the solution that's going to be needed in 3 years' time or 5 years after that. So we have to continually evolve that, and I think fintechs can work and move very quickly. And then the third part, I think, is legacy. We are less encumbered by a lot of the legacy technology systems that banks have to run on, and we can again dedicate a lot more resource and focus onto new forms of technology or building new experiences without the legacy that we have to kind of deal with.
Great, thank you. Ryan, tell us more about the problem you're solving for at Cape and how are you using technology to do that?
Sure thing. It's really interesting actually listening to Bo talk about his journey over the last 10 years, both now and just previously. So we're coming at it as one of the, I guess, the spring chickens, the new players kind of in this space. And what Bo was touching on there, this acceleration in terms of disaggregation of financial services. All of a sudden, there's lots of different players in this battlefield with fintechs. You start thinking about it, and obviously you got the lending space. You then got card providers, card issuers, you got prepaid, you got debit, credit, you got expense management, you got reimbursements, you got corporate travel. What else have we got, Graham?
Oh, thanks for the microphone. Yeah, you know what? There are so many areas of payments and being able to pay. It's really, really important for an organisation to be able to take what often looks like spaghetti bolognese, doesn't it, when you're operating a business, and actually try and untangle all of that.
There you go. Just what he said.
Thank you.
So the problem bit. Sorry, go on, Jennifer.
And how are you using technology?
Great question. So the problem that finance teams have is literally dealing with that. And it's a case of what they're looking for is one platform that consolidates all this down. And what we talk about often is the processes, systems, people, elements, and how that has changed drastically over the last 5 to 10 years, especially when you think back in terms of the last couple of years on the people side. Everybody's remote, everybody's hybrid. Have the systems actually adapted to those changes? So for Cape, what we're about is we're actually consolidating everything down onto one simplified platform, smooth workflows, interconnected. What we talk about is looking at those kind of tasks that typically take finance managers a couple of hours to do. How do we take them to be a couple of minutes? And then equally, how do you get a clean view in terms of your actual cash position? How do you ensure that every single dollar you got in a pocket goes a little bit further? That dollar you've got means $1.50 when it comes to purchasing something. So the way that we look at things is very much as that kind of transaction orchestration layer and actually combining that all together. And the thing that we've realized is it's quite agnostic when you start looking at this from a business perspective. The problems that exist with all these different types of transactions that we just talked about, prior to the transaction being made, are the funds there? Has it been authorized? Is it within budget? During the transaction, in terms of the payment rails is actually going through, is it the most efficient way? To then after the transaction itself, how are you getting it audited? How are you getting it into your general ledger as quickly as possible? So it's about how do you make that whole system as efficient as possible for all those different types of transactions, and that's what we're focused on. Then putting a layer of an intelligence over the top, and the thing that we look at is how do we give our customers all of the power of the finance team without the necessary cost of a headcount increase there, and that's what we're building.
And how do you see the opportunities and challenges in the competitive landscape? And can you see the banks responding and building their own Cape-like solution?
100%. I think it'd be naive to think that any one of us has proprietary rights over this space. And the controversial thing that we talked about before is that there's going to be lots of winners within this area. Getting to market is difficult. I've got no doubt, build by partner, as Bo was saying beforehand. On the partners, some might decide to go down that route. Some might decide to build. We saw the prominence in terms of flanker brands coming through. I'm sure we'll see more, pet projects from new CEOs or would-be CEOs coming through in the bank, wanting to show that they can go build something shiny and new. So I've got no doubt that that will continue to be the case, but it's about how quick you can adapt and then also carving out niches. The beautiful thing in terms of the SME space is it's just so diverse. It isn't a one-size-fits-all approach.
And is that the diversity of small businesses is a great point, because if you think of the different needs of a plumber versus a coffee shop versus a suburban tax accountant versus a hairdresser, these are all small businesses, but they all have very, very different needs. Is that an opportunity or a challenge or a double-edged sword?
It's definitely a challenge. And I think for any startup, the hardest thing is when you're actually getting up and running is being disciplined in terms of focusing on which customer problems you're actually trying to solve. You just can't solve it all. And each one of them has got so many different issues that they come with, and then it's prioritizing them. The most fascinating thing that I find when we look at the business banking space, even right now, it is an oligopoly. It's owned, Big Four own 90% of that market. There is a huge opportunity there. They can't service all those customers. Is there another industry out there? And I'd love anybody to say here that where there is an oligopoly where they'll actually turn away customers so that Prosper can go and help them. No, there isn't. So that's the opportunity there, but it's about how do you work with the banks? How do you partner? And I think that's the kind of opportunity in this industry.
Great, thank you. Graham, Patron, what's the problem you're solving for and how are you using technology to do that?
Okay, and look, it's a really good question. The problem that we see was the customer, the small and medium businesses in our marketplace and most marketplaces around the globe really do have a problem in how they get payment to people. How do they collect the right documentations? How do you pay the right amount of money? How do you control spend? And how do you actually affect all of that happening in a cost-effective and also speedy way? People want to get paid quickly. We need to make sure that we do a better job of making those payments. Now, the way that we go about doing that is we partner with a lot of the banks. We partner with many other fintechs. In fact, I can see some of them even here in the room with us today. And we actually pull together all of that capability to provide a customer front end that will allow them to be able to untangle all of that payment complexity underneath. And I think that's the real power of it is how do we make it simpler for SMBs, for customers to actually affect all of that in their businesses. And I don't think it's a matter of saying it's solving a banking problem or a technology problem. Patron as an organisation really does encapsulate both the fin and the tech part of being a fintech.
Great. Open question. What, other than the banks responding, what about, Amazon or Block, formerly Square? What about some of these overseas players or big tech players? How do you see them in the competitive mix?
From my perspective, I think there is going to be a lot of competition. Ryan, you mentioned it as well, right? Which is, this is a really emerging market. There is going to be lots of organisations, fintechs, banks, other technology providers who are actually going to look at trying to solve these problems. And I think where I see the differentiation, and it's great to be on stage with Bo and with Ryan, because I think they've got a very similar mindset, which is customer first. If you put the customer at the center of everything that you do, that will actually change the way that the technology and the way that you address that problem actually evolves. And so, I think others will get involved in that. It'll become aggregated, it'll become intermediated in different ways. But again, provided you keep the customer at the center, I think that addresses the major issue.
Yeah, to build onto that point, we've seen the emergence in terms of embedded finance, embedded banking, frictionless services, and we know that that's just a path that we're now on. I think the most interesting thing that I look at, and I'm sure a lot of, I haven't been here for all events yesterday and today, but I'm sure there's been plenty of talk around Web3, and what does that mean? It's a new landscape, and for me, some of the things that I'm most excited about are probably more so less the NFTs, not to shame anybody else out there who's an NFT lover, but the DeFi side. I think it's an opportunity to just reimagine, reinvent the financial services landscape with something more efficient, borderless, 24/7. And I think just the cost of capital in terms of bringing that down, I don't think you're ever going to be able to compete with a bank. But I think for fintechs coming into the space, it's a fascinating space. So for me, that is a huge opportunity. It's not somewhere, because the biggest problem that we see within banking, whether it's consumers or commercial, is inertia, in terms of you're more likely to get a divorce than you are to break up with your bank. So that is unfortunately an issue. Whereas Web3, this side here, it is a new land grab. It's a new opportunity. So that for me is a fascinating space right now. And then putting that aside, more specifically on the payments world, if you look in terms of the fact of MasterCard and Visa, obviously we've seen digital payment providers come in terms of Stripe and Adyen and a few others over the last couple of years who have been the real winners in the space. But I think just looking at what's the promise and opportunity with open banking, CDR, not necessarily in the next 12 months, but the next 10 years, and looking at account-to-account authentication, payments, initiation, that for me is a real big opportunity, especially when we're making more and more online payments and moving from offline. So there's plenty of opportunity, and new technologies kind of giving everybody a chance to build something in there.
I mean, just a final thing, all great points as well. One slightly different lens, perhaps, on the big tech approach is that big tech have got their eye on financial services, and we've watched them over the last really decade creep their way into it. And look at Apple Pay, for example, a great example of a product that was launched 8 years ago. Apple have not been in a rush. They've just been taking their time. They've got hundreds of billions in cash. They're fine. They've got a lot of time to get it right. And if it takes them 25 years, they're happy with that. I think the capital market shift over the last 6 to 12 months is creating not so much competition, but more pressure on startups and scale-ups to figure out how do you actually monetize the problem that you're solving, and how do you do that in a way before you kind of run out of money. And I think that's a big shift in mindset for founders in particular, because 12 months ago, there was a lot more capital available, which bought you a lot more time to solve these problems. So whilst there's competition from the one end of town where they've got a lot of time and a lot of money to take their time, there's a different form of pressure that's building up inside fintech. So I think it's really important for founders to be thinking a lot more about monetization of their products than perhaps it was even 6 to 12 months ago.
Awesome. So, Bo, what's coming up on Prosper's roadmap?
So for us, the big moves are in the capital side. We are still building out, 10 years later, that customer proposition. So one thing I've learned about product is it's never done. There's always a way to enhance it. So our core original products, we're still making and building better versions of them, still trying to get that access to capital faster and more seamless and more flexible. So our loan products and our line of credit revolving products are all continuing to get enhanced. But the big move for us in this last 12 months has been the design and build and now release in the last 2 weeks of our all-in-one business account. And that's bringing together effectively a transaction account with payments capability, Right around the corner, we're going to link our credit into that, and we're going to start overlaying a whole bunch of other services into that product. So things like the ability to make payments, integrate with a whole range of different platforms where payments start. We're going to be looking at FX and a whole different array of ways that business owners are actually running their businesses. And again, that's going to be a product category for us that over the next probably 10 years, we're going to just continue to invest in and continually build out that proposition.
Right. And Ryan, what's coming up for CAPE on the product roadmap?
Great question. We're obviously on very much the earlier sides to Bo. So we're challenged with what Bo just put it there. We've only just started onboarding customers last quarter. So really for us, it's about going to market and moving from where we are closed beta into open beta and public launch later in the year. The thing that we talk about, myself, my colleague over there, Ben, is building complete expense nirvana, as our mission. So this 12
Did you say expense nirvana?
Believe it or not, tearing your hair out in terms of those receipts, those bloody expense reports, that shoebox full of them, wherever they are, or the glove box you got. It's about how do we rid people of that pain. So we're trying to narrow down the focus and just go, right, how do we solve this problem? Because it's a real issue for a lot of people, and especially for the finance team in the end of the month. So we're very much just focused on that right now. Fix that, move on to the next piece. So we'll move from expense nirvana is stage 1, and then payments nirvana stage 2, and then everything else for year 3. Let's see.
Okay. And Graham, Patreon is barely 2 years old, and you have achieved so much. So again, to you, what's on your product roadmap?
So Jennifer, yeah, and you're right. I mean, it's incredible to think we've only been around 2 years and we've signed up a lot of customers. And it was interesting. Our initial thought was not to go down the corporate cards track, and we actually did that in response to the customer asking for it. So I want to go back to, we are very customer driven in terms of what we look at doing. We've got some really exciting initiatives that we have launched already and we're already well underway with, in terms of making sure we build very deep integration into the ERP systems to really bring that technology side into the fin side, so that we can actually make that payments process so much smoother. And I think the other piece out of all of this is this ability to be able to make sure you manage all of the documents that become part of the life of every business, and manage that in the most efficient and scalable manner. And so we're moving down those tracks.
Fantastic. I think now, do we have some time for some questions for the audience? Does anyone have a question for the panel?
Excellent.
Hi there. Hi, Ryan. So you've joined us over from the UK, so I'm just really interested to see, what have you seen as the differences between the Australian market and the UK market from what you saw from a business banking perspective?
Oof.
That's a big question.
Great question. Funny enough, we were talking about this, it just beforehand, and it sounds like you're from the UK as well. Yep. So good to meet you. The differences in terms of the two, I think you can date back to the GFC and the impact that had. And we were talking about this in terms of just it being this catalyst in terms of all of these new propositions coming into existence. And it was an incredible time looking back 10 years ago. All of a sudden the banks came out of the market, the first wave of fintechs, fintech lenders, Funding Circle, iWalker, these kind of guys coming through. And really kind of being at the epicenter in terms of, we like to think the epicenter in terms of Europe. Obviously, that has changed. But there's still the thing is, all the talent going into London for the last 10 years, all the VC dollars, and it's actually put startups and scale-ups onto hyperdrive. So it's a very saturated market. It's very hard now to actually go and get enough market share there. So incredibly competitive. I'd say in terms of Australia, competitive. I think we talked about the oligopoly kind of nature. I think the Competition Markets Authority in the UK, who kind of regulate the kind of big 9 banks, have done a pretty good job in terms of opening them up. I think in terms of Australia, we're still at the earlier stages of that. There is still a large amount of market share with them, which presents a great opportunity for new fintechs coming through. So very different in terms of feels like right now, but a great opportunity for fintechs coming into this market, not as saturated is how I feel, but it's very competitive still. Hopefully that answers that.
Any other questions?
Is that a stretch or a question? Stretch. I think you've done such a good job, Jennifer, that every question anyone ever had has been answered. So, ladies and gentlemen, please thank our fantastic panel, Bo, Ryan, Graham, and of course, Jennifer.
Thanks, guys.
Well, now we're going from battling with the banks to being in battle with the bank, being part of the same side, looking at partnerships, bank with fintech. And to do that, we've got a couple of fantastic speakers. Mark Collis from the Newcastle Permanent Building Society. We have Michael Starkey from Athena Home Loans, a fintech that has built an extraordinary business here in this country. And to moderate this panel from ACS Labs, we have Siobhan Casey. So, ladies and gentlemen, please give our next panel a big hand. Thank you.
Thanks, Simon. One quick edit. We have, Mark is not here. We have Brian, Group Treasurer from Newcastle Permanent Building Society. And we also have a very interesting stat. We have Newcastle Permanent Building Society opened in 1903, having a partnership with a business that opened in 2017, so 114 years between the two gentlemen here on the stage in business entities, of course. So over to both of you. First off, what your role is, and then perhaps what you could talk about initially is how you came to be in a partnership. What was the pain point you were both trying to solve?
Yeah, so Michael Starkey, co-founder, chief operating officer, also CFO for Athena Home Loans. We started the business, as you said, in 2017 with a view to really being a non-bank lender, so cutting the spread between where wholesale money is originated and where retail borrowers get their money. We had always envisaged a sort of a whole loan sale or portfolio sale arrangement to how we funded our mortgages. And we can talk a little bit more about later about how we see that working in the broader economy. But we began our journey with traditional warehousing and securitisation markets. And we were introduced to Newcastle Permanent by KPMG, actually. They were working with Brian and the team there, and they introduced us in March 2020 through a person I used to work with back in my consulting days. And
was it before the 17th when everything shut down, or after the 17th?
It was after. This whole thing was done in COVID. We were supposed to meet face to face, and then at the last minute it turned into a Zoom. And so I only met the guys about a year and a half after we'd done the whole deal.
Brian Reid, Group Treasurer of Newcastle Permanent. As the guys have mentioned, we've been around for a long, long time, and we're really a member-based organisation, which differs from banks in that we're there for our members, and members own the equity in our organisation. So we're a small-sized bank, and I guess one of the key changes we've seen in our organisation over the last couple of years is really a tilt towards innovation and growth. So, we've been a staid, very conservative organisation for the last 115 years. I guess with the need to continue to have relevance in the retail banking market, we've had a much clearer focus on developing partnerships with guys like Athena, but also more broadly in terms of looking at opportunities to better meet the needs of our customers now and into the future.
Cool. So let's walk through the relationship, the partnership, and what was that ideation process like? What were the big challenges maybe that you identified?
So for us, it's really, as a non-bank, we can't create money out of thin air like ADIs can, so we have to source wholesale funds. We had done so through warehouse arrangements with big wholesale banks, both domestically and globally. We've got a securitization program and all the rest. But our vision was to actually simplify that process and source funds directly through a non-structured way in arrangements like this. We initially, when we set up the business, we initially thought that was going to come from superannuation companies. So we wore out a lot of shoe leather meeting every super fund in the country. So we always had that vision of sort of whole loan portfolio sales as a way to fund a mortgage, as a more efficient way to fund the mortgage book. So for us, it's really A, around growing the book, so we needed to source funds. B, around diversification, because as we saw in COVID and at the GFC and actually right now, wholesale funding markets can be very disrupted. So if you have a diverse set of funding arrangements, you're going to be much more resilient through the cycle. So really, and then the third one for us is really it's a capital efficient play. We want to be a processing business. If you look at most lending companies, mortgages is on the capital efficient side of things, but they can be very capital intensive. So to grow a book we've settled 5.5 billion loans now. If you're not very careful with how capital efficient you are, you end up asking your equity holders to put in millions and millions of dollars equity capital. So those three things for us: capital efficiency, diversity, and just growth.
Yeah, it's interesting. Many of the points Michael raised are also key points for us as well. And that I think if you look at the transaction, it's really a complementary transaction for both parties in the sense that Michael has a need for capital optimization, as do we. So we need to put capital to work for our members to generate profitability, to bolster up the capital for when times get tough. And also, I'm not sure if you remember, in the middle of COVID, loan growth had really suffered. So as a consequence, we had a balance sheet that had over $1 billion worth of equity and probably about $600 or $700 million worth of surplus deposits. So, as Michael mentioned, there was a need for a partnership model that really works well for both parties, and that bizarrely we satisfy each of our needs in both ways. So.
And any regulatory challenges? Did you have to engage with APRA, or was it fairly straightforward?
Yeah, look, we're a pretty heavily regulated entity. So, I guess one of the key things here is to make the deal really successful is generating a capital treatment from APRA that reflects normal mortgages on our balance sheet. And we had to go through quite an extensive due diligence process to satisfy APRA. And that put a lot of, I guess, not so much stress, but a lot of work on Michael's side and Michael's team to generate some of these documents. And I think your treasurer mentioned it was akin to an equity raising at one point, just in terms of the level of DD we went to. And it also means that there's significant ongoing governance activities around these particular transactions. But if you look at it in terms of good business management, a lot of what APRA has in place actually is the right thing to do, irrespective of its regulatory obligation or not.
Anything to add?
No, so as a non-bank, we're not APRA regulated, so it really was satisfying the needs of APRA. But I think it was really encouraging that APRA was supportive of this sort of arrangement, because I do think it speaks to the broader opportunities. Because the big picture here is really around capital flows and where borrowers ultimately get money from and how that is funded, right? And so the fact that they were willing to engage and support this sort of deal, I think, is a really good sign.
Can I ask a question? You got together. The relationship kicked off at the infancy of COVID. If not for COVID, do you think this would have happened? Or is this a COVID baby?
On our side, we certainly would have still had the need because we were growing quickly. I think what COVID did was underscore how important it was for organisations like us to not purely be reliant on one source of funding. So, as I said, we've settled now 5.5 billion. At the time that COVID hit, I think it was about 1.5 billion. And we were sort of reliant on one or two big institutional funders, which had the jitters during COVID. So COVID really, for us, underscored how volatile and fragile the capital markets can be. And for a business like us that needs a consistent flow of funds to grow our book, it really underscored the importance. So our need would have been there, whether or not your surplus liquidity would have been as much of an issue. Yeah.
Look, I think when you look at what banks do, banks effectively look to generate mortgage growth. And they do that through various distribution channels. So we've got essentially two prime channels, which is our broker network and our principal channel. So what Michael's deal pulls together is an alternative distribution channel, which allows us to diversify outside the Hunter region. So Michael's book is national, which gives us a fantastic opportunity to diversify the absolute level of credit risk across our portfolios. And that actually generates quite significant benefits from both a risk perspective, but also in terms of how we think about different touch points nationally.
It's sort of a good lead on then. So when you started this relationship, you probably had key measures of success that you were looking to achieve. Were they achieved? It sounds like they were, but did you find any other mutual benefits along the way? And what do they look like?
Yeah, so for us, I guess jointly, the economics had to be sensible for both parties, and I think it's been beneficial there. We didn't want to introduce any undue risk again to both parties, and I think if anything, as Brian said, we've probably diversified and sort of reduced risk in both parties, I think there. And then operational complexity. What we didn't want, we wanted this to be a very efficient transaction. If you think about and there would be various levels of understanding in the audience around how structured deals work when you're trying to finance a business through RMBS. It is quite complicated because there's lots of different parties involved and lots of different legal arrangements involved in an RMBS structure. What we aim to do here is to keep that quite simple, and so that operationally, I mean, when we did our last transaction earlier this year, it was it was very straightforward. And so those three objectives for us were met.
Yeah, look, I think as any sense of true partnership, I think we all learn from each other across time. So, there's aspects of Michael's business that, our executives have picked up and learned from. I'm sure there's some aspects of our business that Michael's potentially learned from as well. So it's more of rather than a transactional relationship, it's more of a deeper partnership model. And it's about actually sharing the knowledge and information that we pick up more broadly to make the partnership better.
What other interesting partnerships have you seen between the sort of traditional banking and the fintech space?
Yeah, look, I think there's a couple of really interesting ones out there at the moment, and the different variations on the originate to distribute model. So you've got fintechs such as Nano, who in some respects are a little bit similar to what Athena does, but they're also looking at, I guess, the software solutions that come off the back of it. And then there's other pure loan players that are probably smaller variations of Michael's business. So I think there's a fair bit of diversity in terms of what fintechs are actually doing out there. I guess the challenge is, and Michael touched on it, is how you diversify your model to ride out the longer term ups and downs of the economy and financial markets volatility more generally.
Yeah, I mean, for me, it's one of the big changes in the financial services scene over the last decade, because I was at NAB for 10 years before starting Athena. And I think you've seen a lot more of these sorts of arrangements that you referenced. So you had the likes of Nano and TikTok, and I saw Dom floating around there from Upbank. I think that's a super example of a brand new sort of Ferocia, a brand new company working with a traditional lender in Bendigo. So I think you're seeing a lot on in the payment side. You're seeing a lot on the transaction banking side. Lending has been more. I think what we've done is actually a little bit quite different and unique in some ways. Lending has tended to be more arm's length wholesale funding arrangements to date. So I think you will start to see more and more people looking at their legacy platforms and saying, okay, I could either rebuild this from scratch in a very large and risky project, or I could sort of piggyback on the work that a new player like Athena has done. We've probably invested 100 million in our platform, and we're about to announce some really exciting partnerships with players, very powerful players, but who just want to accelerate their path to market. Yeah.
Awesome. Let's stay with that, Michael. The mortgage funding point of view in Australia v overseas. What are the key differences, and what do you think we could learn from the overseas markets?
Yeah, so the big difference, like if you think about Australia, it is very much dominated by banks. So ADIs account for, I think, around about 95% of all mortgages written in this country, and it's probably something that those of us who've lived in Australia our whole lives sort of take for granted, but it's just not the way other markets around the world are shaped. So in America, non-banks account for about 50% of the market. They took a bit of a hit during the GFC, but they've recovered to about 50% of the market. So you have capital markets that support non-banks participating really strongly in the prime space there. So players like Rocket Mortgage are now, I think it might even be the biggest lender now, home lender in America. It's a non-bank. So they sort of fund themselves in a similar way to what we do. So that sort of market, in the Netherlands, you have superannuation funds and insurance companies buying directly portfolios of mortgages from mortgage originators like us. That's the vision that we had. We haven't quite cracked that. We haven't given up on that vision, but we do see that super funds hold hundreds of billions of dollars of bank deposits. They have billions of dollars of bank equity. They have billions of dollars of bank mezzanine finance. What they're really funding there through a very inefficient way is a mortgage. And so why not just buy the mortgages directly? So that's, we are of the view that, there's scope for Australia to look a little bit more like America or Canada or Europe, where non-banks are, instead of 5% of the market, are 30, 40% of the market, and that's the wave we're trying to ride.
Is this a regulatory issue that needs to change in Australia for that to occur? What's got to be the stimulus?
It's a really good question, I think, and it's one we ask ourselves all the time. How do we unlock this? It's clearly not the way it works in overseas markets, but it seems difficult here. I think it is a combination of some regulatory issues. So there's a couple of examples there. One is the way capital treatment works for wholesale lenders. There seems to be a little bit of a punitive treatment there, which means that large wholesale banks can't own, they can only own AAA to get favourable treatment. Brian would know a lot more about this topic than me as a treasurer. So there's a combination of things. That's one. The other is to just look at superannuation and how we judge our super funds. We tend to judge our super funds purely based on return, not a risk-return balance. So Aussie super funds are very heavily skewed towards equities, and they looked at, when we tried to pitch our idea, we got quite a lot of interest, but ultimately it was a very boring asset class for them, and so we didn't get a lot of take up there. So it's a really good question. What is it going to take for Australia to head down that path? But one thing's for sure, it needs players like us to be originating high-quality mortgages, and then hopefully we'll get the support on the other side.
Great. Brian, how can the mutual sector leverage new technologies to remain relevant?
Well, I think it's not how can they, it's how will they. Because if you look at the banking sector at the moment, retail products are essentially a commodity-based product. So margins are very tight. So OPEX management in terms of more efficiency, reduced FTE costs, etc., is the new black. So when we look at potentially efficiencies across the organisational stack, fintechs will play a major part in that going forward. So that's anything from making the AML KYC process more efficient, all the way through to the whole concept of how we think about open banking and trying to monetize some of the values coming off the back of that. So it's going to be a much more competitive environment going forward, and we're starting to see that through the mutual sector already, with a number of smaller type partnerships popping up.
Yeah, there's been a lot of consolidation in your sector. That obviously gives you more, I suppose, buying power or more influence over perhaps sharing new technologies for the space. X15 Ventures yesterday was talking about opportunities in the future around saving money from their OPEX spend year on year. It's generally much higher in the mutual space. What are you seeing in that area?
Yeah, so there's a couple of things going on. So you mentioned the consolidation in the mutual space. So at the moment, there's two large mergers going on. So you've got the People's Choice Heritage merger, which will produce or generate, if successful, the largest mutual group in Australia, circa 22 billion in assets. We've currently got a merger in play at the moment with Greater Bank, and we'll land at about $21 billion of assets. So as you can see, the sector's starting to bifurcate just in terms of size. So I think that the real challenge there is, going forward, how do mutuals utilise that size and, to your point, buying power to make the entire process more efficient. So as I said earlier, it's a commodity-based business, but unfortunately the threshold for success isn't 20 billion, it's much larger. So to get those optimal levels of scale we see across the larger banks, I guess the line in the sand is probably $50 to $60 billion at a minimum. So I think the consolidation piece is going to play out a lot more as we evolve over the next 5 to 10 years.
Okay. I'm aware, again, I've seen them on the floor and people have referenced that we've got all the regulators here at Intersekt, which is great. Maybe they're in the room today, I'm not sure. What role do you both feel that they have to play in relation to facilitating innovation within our sector?
So I think that really important role, and there's a lot of important consumer protections because there's a lot of cowboys out there, and I think all of that regulation is something that fintechs should be able to deal with more efficiently than in some ways the larger legacy players. So really important role in protecting consumers in that space. I do think there's a balance on the prudential side and the competition side as well there. So I don't think it's in anyone's interests to have all of the banking so concentrated in this country among just the big four. And you see now Suncorp now part of ANZ. So there's really only the mutual sector plus two remaining, I would say, regionals in BOQ and Bendigo. And then fintech. So I think the role the regulator can play, and I'm talking about the RBA and APRA and obviously the ACCC, is to sort of recognise the importance of healthy competition. Think about the way in which they approach prudential regulation and also interventions like the COVID intervention. Think about how they're going to impact the various constituents there to facilitate competition. Because, as I say, it's in no one's interest for everything to be concentrated in the big four. So there's lots of sort of parts to that. I think there's what are the capital rules? How can you encourage the non-bank sector? How can you support the mutual sector in providing that competition that's sorely needed? From an ACCC point of view, how can you look at some of the lending practices there, particularly around the mortgage discharge process? There's a lot that can be done, and we'd sort of almost welcome a continued dialogue with all the regulators to inject ideas into that scene, right? We do need competition.
We've got afternoon tea in about 10 minutes,
Okay,
so you can chat over coffee and cake. I might actually open up to the audience a bit more time for anyone to ask any questions of this relationship or anything to do with fintech and more traditional mutual space.
There must be some questions. I'm going to ask one just off the back of, I realised I'm one of the 5% because I am my mortgage lender is not an ADI institution. But I did have this thought, mortgage insurance. How big a piece of bullshit is it, and how soon can we get rid of it? Because does anyone ever have a mortgagee sale where the bank loses its money?
It's really good. So let me set the scene. You can have a shot at this as well, Brian. I won't let you off the hook. But we've only to date lent a less than 80% LVR. So we actually don't have LMI in any of our arrangements, just by virtue of which part of the market we're playing in. I think you do have to be a little bit careful in that Australia hasn't really had a recession in 30 years. And so we don't, other than management judgment or about what's going to happen in the future, you don't really have any history to rely on. And what would really happen in a genuine downturn would be the question on my mind. What I struggle with mortgage insurance is a little bit like what happened in the GFC. If you do get prices falling by 40% across the board, then those insurers are nowhere near well capitalized enough to support what would then be the result. So it really it's more an isolated issue that organizations should probably end up self-insuring for. So that would be my take.
Yeah, pretty similar. I think the fact that when you look at the quantum of mortgages in the market that do have LMI, you look at the balance sheet of the LMI providers, and even a relatively medium-sized downturn, they're going to struggle to pay out claims in full. So you probably more broadly question the logic of having LMI more generally. I get the point that, in essence, there needs to be some protection for the originator for more riskier mortgages. The question is whether it's an upfront fee or through price. So we can always go down the path of risk-based pricing for the additional potential risk of much higher LVR mortgages, but again, that creates a different form of tension in the market.
Thank you, gentlemen. Now, question.
Hi, you sort of mentioned, I guess, the concentration in the big banks. The big banks themselves are profitable enough to consume a lot of fintechs, and often that's even the exit strategy for a lot of fintechs. I'm wondering what your commentary around, how do we do anything about that? Is it a good thing, or it potentially forces itself to narrow and get and consolidate anyway?
I think it's a really good question. My view is that you can't discourage it too much, you can't shut down that avenue of exit too much, because there's many because you might inadvertently discourage entrepreneurs from going out and starting a business if you say either you succeed completely independently and we're not going to let a bank buy you. Because that is a pathway that's always in the back of a mind. Even like Athena's been a great business. It's a fantastic business, and our plan A is not to sell to a bank. Our plan A is to be a great independent lender. But if you were to say that's not a pathway available to you at all, then it just introduces a new level of risk for entrepreneurs there. So I think that balance between encouraging people to start businesses, knowing that if they hit a single and not a home run, they can still maybe fold it into a bank and keep going. I think it's important. It's an important thing. A lot of, we're just having a conversation around partnerships between fintechs and banks. A lot of great fintechs are providing services to the banks, and so they're an important part of the economy as well. But the broader point about there is a concern I have around that concentration. So I think, but the answer is to provide an environment in which firms can flourish independently, because I don't think it's many people's plan A to end up selling themselves to a bank. But it's kind of the reality when the environment, like look at the was it 86-400? They had great sort of ambition to become a bank, and I think when COVID hit, it was just too difficult. So, and they had a brilliant exit and all the rest. So the answer is more create an environment that businesses can thrive in, so they don't have to,
Hi guys. Sean from Nano Home Loans. So thanks for the shout out. My question might be a little bit cheeky, but really keen to get, well, both your views actually on if you were starting again right now as a kind of a new company, what advice would you give to budding entrepreneurs that are entering the home loan and prop tech space? And do you see any niches, right at the grassroots level that are underserved and need extra support?
I think he's after your strategy.
No, so, and I think what both of our organisations have demonstrated is that there is, in a $2 trillion market that has a very complicated value chain, there's all sorts of different ways of playing in that value chain. We've gone down the path of being very much a non-bank end-to-end mortgage player with our own funding program and marketing and distribution and brand and all the rest. But there are very successful models that are completely different, like a Lendy, who is a digital broker, if you like, and then yourselves are doing service provision into places like AMP, right? So I don't know a lot about Nano, but I think it is just such a large market, so dominated by companies that have legacy technologies, like something like 95% of the mortgages in this country must be written on very old tech in origination stacks into very old tech servicing stacks. And so there's just tremendous opportunity to have better origination capability and better servicing capability. And whether you do that by playing in one slice of the value chain or try to do something end to end, or in our case, we were trying to do something also with the capital flows, as we've just been talking about here. I think there's just lots of different ways of attacking that market, and I think there's huge opportunity for great businesses like yours and ours to succeed there.
Brian?
I think it's a really good question. I mean, I think the first thing you've really got to ask yourself is, do I want to compete with banks head on or major banks head on, or do I want to pick pieces of the market out where major banks may be disadvantaged via regulation, complexity, or just general size of the market or operational efficiency? So I think in that context, both yourselves and Michael have picked out, I guess, areas where banks have specific pain points. And I think that the key to that is putting the customer's needs first, but also doing it in a really efficient manner. So as I touched on earlier, this is a commodity-based market. The way you extract value from the market is not only meeting your customers' needs, but also doing it in the cheapest way possible without cutting corners.
Thanks. I think one more.
Hi there. I'm happy to say that I'm an Athena customer. So not to call myself a cherry, but it feels like in terms of Athena, the sort of cherry picking strategy of like going after customers that are relatively low risk in terms of trying to like pull them from the banks and like from a better service standpoint, being able to offer like a better price. Has partnership with like Newcastle Permanent allowed you to sort of expand your risk appetite in terms of the types of customer that you can serve? Because it's still a huge problem in Australia in terms of people's access to mortgages. So that's still my only concern. Like a lot of the fintech and home loan market is still sort of attacking the sort of cherry picking problem, as opposed to trying to solve it from like the customers are still massively underserved.
So it has the potential to, and we haven't yet. So what we've done, and we've actually already had these types of conversations around what more can we do with that partnership. Our strategy is actually, it's a classic Clayton Christensen disruption strategy, right? Which is you come in with something very basic and then you build up over time. So when we started when we launched in 2019, it was redraw only, very strictly, almost PAYG. We only had a refi product, so you couldn't purchase, right? Then later that year it was purchase and refi. Now we've got an offset account and better payment capability. So we sort of gradually got better and better in terms of product features. What we're doing now is we are looking at different segments now that we've got that base in place. So we will be able to expand out and do 80 to 85, for example, very soon. We will be able to do more business purpose. We'll have more of an offer for investors and other sort of more specialist segments. So the partnership with Newcastle hasn't yet done that, but that's exactly the sort of thing that you guys would have appetite for and we could work together on. Yeah.
Yeah, I think the really relevant point there is the capital framework changes as of 1 January, and those changes are going to drive those sorts of pricing dynamics across the market. And I mean, I think the broader question is, if I missed it, I apologise. It's more of financial inclusion, so how we offer products more generally across the market that meet not only the great mortgage customers with great credit quality, but the great customers with lower credit quality. And I think that's always a challenge under the risk-weight capital framework, in that there's a really tough upfront cost in terms of LMI, plus the risk-based capital charge that'll go with that. So I think, to Michael's point from before, the areas around financial inclusion are areas we need to work with both the regulator and the government to think more broadly about that balance between system stability, but also what is social good.
Excellent. I think we've finished on that afternoon tea. If everyone could join me in thanking Michael and Brian. Thank you.
Please thank Siobhan as well. Guys, you've got half an hour. Enjoy the cakes, a little bit of a sugar rush, a little bit of a caffeine hit. We've got 3 great panels to come. We'll see you back here at 3:30.